Okay, let's talk about the fascinating and sometimes frustrating world where money and our minds collide. Why do really smart people make totally irrational investment decisions? Well, it turns out our brains have a few, let's call them hidden glitches, that can seriously mess with our financial goals. So let's dive right in.
This old saying from Wall Street pretty much nails it. Now, of course, it's a bit of an oversimplification, but it's the perfect starting point for understanding the powerful psychological traps that get all of us, from total beginners to seasoned pros. These two forces are always there, pulling the market and our own decisions in completely opposite directions.
So let's break down how these two primal emotions can work against our own best interests. Greed and fear, they are wired deep into our DNA, and when money gets involved, man, they can be incredibly persuasive. So on one side, you've got greed. It's that little voice whispering in your ear, hey, you can get rich quick. Ignore the risks, just jump on this hot new thing. It's what fuels market bubbles and gets people chasing fads. And on the other side, you've got fear. Fear is that primal scream that causes investors to panic sell everything at the absolute bottom of a crash, or just avoid investing altogether, missing out on decades of potential growth. First up, let's talk about this siren song of greed. I mean, it's seductive, it's exciting, and it creates these specific mental biases that can lead to some really disastrous financial outcomes. This line from the movie Wall Street is iconic for a reason. It perfectly captures the vibe of a crazy bull market, right? It's that feeling that the party's never going to end, the profits are just going to keep rolling in. But, as we've seen over and over again, that exact kind of thinking is what leads investors straight into some very dangerous traps. And that brings us to this amazing term, irrational exuberance. It was made famous by the former Fed chair Alan Greenspan, and it just perfectly describes the psychology of a bubble. It's that moment when logic and spreadsheets get tossed out the window, and all that's left is pure, unfiltered greed and this belief that prices can only go up. The dot-com bubble is the classic case study, right? People were pouring money into internet companies that had no profits. Sometimes they didn't even have a real product, but they were convinced the old rules didn't apply anymore. They were caught in the grip of greed, and a lot of them saw their fortunes completely wiped out when that bubble finally burst. Now, this is a particularly nasty form of greed-fueled thinking, the superiority trap. It's that little belief that you're the exception to the rule, that you're smarter than the market. You can see things nobody else can, and you can outwit all the pros. It's an overconfidence that makes us incredibly vulnerable. And get this trap isn't just for amateurs. Studies have shown that even finance professors have fallen for it, totally convinced their academic brilliance meant they could beat the market. They learned a very expensive lesson. When it comes to investing, being smart just isn't enough to protect you from your own brain. Okay, so that's greed. But now let's flip the coin, because fear can be just as destructive to your portfolio, if not more so. Fear doesn't just make us hit the sell button, it makes us make all sorts of irrational choices just to avoid feeling pain. Have you ever done this? You're holding onto a stock that's just tanking, and you keep telling yourself it'll come back just because you've already lost so much on it. Yeah, that is the sunk cost trap in action. It's driven by the fear of admitting you made a mistake and actually making that loss real. It just feels easier to hold on and hope, even when all the data is screaming at you to sell. This one is one of the most powerful forces out there, herd behavior. When fear really takes hold after a market crash, you see this mass exodus. Investors just sprint for the exits, not because of their own research, but simply because everyone else is selling. It's a collective panic, and it often happens at the absolute worst time, locking in those losses right at the bottom. And here's why it's so hard to fight that urge. It turns out that feeling of being isolated is more than just in our heads. It's almost physical. Our brains are hardwired to find safety in numbers. So when you try to go against the crowd, your brain can actually register that as a real threat. That's a powerful instinct to have to overcome. So it's not just about these big, raw emotions like fear and greed. Sometimes our brains are just trying to be efficient, They take these little mental shortcuts to save energy. The problem is, when it comes to investing, those shortcuts can lead us way down the wrong path. Anchoring is such a weird one. Our brains will grab onto the very first piece of information we hear, like, say, the price we paid for a stock, and use that as a reference point for every future decision, whether it's still relevant or not.
That one number can completely warp our perception of what an asset is actually worth today.
I mean, think about Radio Shack. For decades, it was a hugely successful company, and investors were anchored to that history, to that old stock price. They just couldn't see that the world was changing right in front of them. Even as the company was clearly failing, so many people held on, anchored to a past that was gone, unable to accept the new reality. Okay, so if our brains are wired with all these glitches and we're so susceptible to fear and greed, how in the world do we fight back? How do we make better decisions? Well, the answer isn't to try to get rid of emotion, but to master it. This is where something called emotional intelligence, or EI, comes into play. And it's not about being a robot, not at all. It's about being aware of your emotions and understanding how they're pulling your strings. It's about using that awareness to think more clearly and make more rational choices, especially when things get stressful. And listen, this isn't just some feel-good theory. There's real data here. A fascinating study from Harvard looked at professional portfolio managers, and the results were crystal clear. The managers who performed the best, the top 25%, also had the highest average emotional intelligence scores. And on the flip side, the worst-performing managers had the lowest EI scores. That shows a direct, measurable link between managing your emotions and managing your money. And who says this best? The master himself, Warren Buffett. He puts it perfectly. He says investing isn't a game where the person with the highest IQ wins. What you really need is the right temperament, that emotional discipline, to control the very urges of fear and greed that get so many other people into so much trouble. So the first step to winning this inner game of investing is just self-awareness. So think about it. Are you more likely to get caught up in the thrill of greed or the panic of fear? Do you find yourself anchoring to old prices? Recognizing your own psychological tendencies is the single most powerful tool you have to protect your portfolio from your own brain.